Welcome back, everyone. Happy New Year and welcome to this 2021 Hidden Gems webinar series. Now, not much to talk about. Not a lot of people are back in the market, so I'd prefer to refer straight to our experts who are presenting today, other than to say 2021 has kind of finished where, or started where 2020 has ended, particularly with the stocks presenting today. There's a lot of chatter and a lot of interest. So don't be afraid to ask any questions. There's a Q&A box. Type the questions. Don't put your hand up. We can't see who you are. Now, here's a fact, an interesting fact that came from Perennial Value. Did you know of the 77 IPOs listed last year, 54 came in the last quarter? So there was a real rush to get to market, probably ahead of the US election. So we're going to kick off today with Perennial Value and have a keynote presentation by Andrew Smith, and that will give us a better understanding of the valuations that are in the small cap, micro cap and IPO space. Now, Andrew is the head of smaller companies and micro caps for Perennial Value, managing over 500 million. He's involved in the portfolio management of both the small cap, micro cap and pre-IPO and unlisted company investing, and that's via their private to public opportunity fund. So I'll now pass over to Andrew to get his insights into the risks and rewards he sees in 2021. Andrew, thanks for your time, mate.
Thank you, Tim, and thanks for the invite to speak again. Just start with the disclaimer. Obviously, anything I'm talking about today is more in reference to how we think about things from our fund's point of view, rather than giving you a buy or sell recommendations. Is purely just giving you insights into how Perennial manages money. We can probably skip over this slide, just shows you we've won several awards in small and micro caps. This slide I want to spend a bit of time on, and what I want to point out is the market is inherently cyclical. You've got to be a long-term investor mindset to actually make money, because as you can see, there's some pretty big dips in there. What we're showing you is our smaller companies fund, which has been around the longest, how that's performed over time, net of fees, versus the small cap index in grey and the large cap index in blue. So obviously, there's been a lot of challenges thrown at the market, and obviously COVID is fresh in everyone's mind, and that created a very big sell-off. And we were no different, as you can see in our sell-off in our fund. But I guess what we see in each cycle is an opportunity, and the opportunity is always different. So at the bottom of the GFC's probably got the most similarities to what we saw last year. We started positioning towards the end of that for a cyclical recovery driven by government stimulus. So we did that again at the bottom of COVID. We positioned the portfolio for recovery trades and have done very well out of it. We also positioned in healthcare, resources, and even some lithium stocks. And actually, I noticed there's some presenters from both those sectors today. So I just encourage people to think that there's always some way to make money in the market. You've just got to spend the time and look for those sectors that are going to benefit from the current environment. So the way you made money last year, to Tim's point, in 2020, perhaps there's a different way to make money this year. It's very rare that you make money the same way in the next year. So we go to the next slide. This is informing our opinion at the moment, and this was a big driver for us going overweight cyclicals sort of mid last year, and it did very well for our fund. So we had both monetary stimulus, so the RBA cutting rates, but we had unprecedented fiscal stimulus from the Australian government. And I saw a stat just this morning that Australia has the third biggest percentage of fiscal stimulus after the US and Japan. So that's really interesting to us in the context of Australian economy holding up much better. So we're sort of wondering if now the risk is the government might start pulling back some of the stimulus, because perhaps the Australian economy doesn't need quite as much stimulus that it's got. So we're probably rotating out of some of the trades that have done really well, like retail sales. You would have seen Christmas was a bumper for most people, and we're starting to shift to other areas. So resources we think is really good because supply is tight and demand conditions globally are improving. So resources is an interesting sector, and I'll touch on that later. But also we were discussing just in our team meeting this morning that business to business may pick up, because business confidence was low most of last year. A lot of companies ended up with better balance sheets than they thought, so they maybe start spending again, whereas we think we've already seen the consumer spend. So that's just something we're thinking about in terms of informing how we make money this year. If we go to the next slide. The other challenge we've got is valuations. So valuations are pretty extreme. This is the small cap index in blue. The perennial value smaller companies fund is marked in X, so you can see we're a pretty big discount to that. But versus history, valuations are very stretched. So we think it's a risky time in the market. So you've got to be really careful, really comfortable with the cash flows we think that are getting generated by your businesses, and that you've got a really sound investment behind, really sound fundamentals behind your investment. The other consideration with those elevated multiples is there's some companies that were hit hard with COVID, so they'll grow into those multiples. So it's not really like for like, but the starting point's not great. And we're also seeing long-term interest rates starting to just slowly move up in the US. That will hit high growth companies because people are no longer waiting for earnings 10 and 20 years out. We're going to shift back to, which we haven't seen for a while, to more of a value style where 1, 2, and 3 year earnings become more important and more of a focus for investors. So we think that's an interesting backdrop for this year. We saw the back end of last year and so far this year, that shift of value stocks outperforming growth stocks is something to watch as well. But what's more important than any of that is just buying good companies with good fundamentals and cash flow. If we go to the next slide, we've got a very big team. We look at all sectors in the market. So we've got healthcare experts, financial experts, tech experts, private company experts. So we do shift between sectors, and we think, Australian stock market's great for that. You think of an exposure, odds are you can find it. We're really excited about the amount of opportunities out there. And you can see on the next slide, we have a universe of about 900 companies that we can invest in. We're only looking to buy 60 to 70. So the Australian listed market is very healthy. Tim mentioned the amount of IPOs that came last year. Yes, they were rushed, but there was some really good quality names that came through. We participated in some of them. We'd either been there as private investors or we participated in the IPO. So we think the quality is growing, the universe is growing, and that's really encouraging. Next slide, just a quick reminder that everyone spends a lot of time thinking about what they're going to buy, but it's equally important what you're going to sell. And just to give you one example on the next slide, Freedom Foods is a company, we really like the product. We thought there were some good fundamentals. And on the next slide, you can see there, we actually crunched the numbers, had some concerns, weren't getting the right answers back from management. So we sold that in February, in the reporting season. That stock's been in trading halt for most of the year and still hasn't really come back. So doing your own homework, going through the accounts, doing the boring cash flow analysis, can really avoid some nasty losses. So just, sell discipline is just as important as buy discipline in our mind. Next slide. We think this is a really interesting slide. So what this shows is the commodity index versus the S&P 500. So obviously you get a longer history from the US and basically the relative performance. So the peaks in this chart is when commodities are outperforming equities or the broader equity market. And as you can see, there's been a very long decline of commodity names versus the broader equity market. That's starting to turn. You can't even pick it up on this chart, but it did actually start to turn in December. We've actually made some really good money in the resources space. We think this could have a multi-year recovery. Supply is constrained. There's been no capital going into resources. Demand starting to pick up with everyone stimulating around the world. So we think resources as a complex is going to be a really interesting place to invest. And that's probably one of our highest convictions for this calendar year. If we go to the next slide, just a couple of examples from both our smaller companies fund and then I'll talk to our microcap fund. While we do have certain sector views, we do spread our risk quite a lot across stocks. So you'll see in this, there's no resource names that are in the top 10. We tend to spread them across, a large, for example, lithium, we've got 3 exposures. We'd rather have a number of them rather than put our eggs in one basket, just given the mine-specific risks, for example. We've got a spread of industries here. Alliance Aviation, which services the resource sector and has actually put out 2 profit upgrades, probably the only aviation stock in the world to have had profit upgrades last year. We've got a Unity Wireless, which is a broadband provider, so pretty defensive. Integral Diagnostics, a healthcare radiology provider. MoneyMe, personal finance. So quite a big spread in the small cap space. If we go to micro caps, the next slide, again, we don't have huge positions. We tend to spread our risk across a large number of names. SciDev is a great example of what we're looking for. This is where we saw the cash flow inflection coming through in the quarterlies. So a lot of companies in smaller micro caps get quarterly data, and we saw the cash flow coming through, the revenue growth coming through. We met with management, highly passionate, had been in a much bigger organization, took those skills to SciDev, bought equity on market, which is great alignment. It's one of our high conviction names and just put out a good result recently. MicroX also just announced in the last few days another one where we bought, where we think they're close to that inflection point of going to positive cash flow, and that's really what we think ultimately drives share prices is cash flow. So if we're picking up companies as they flick into positive cash flow and growing cash flow, we think that's going to be a good driver of earnings. And encouraging all, Good Drinks Australia owns Gauge Roads. So if you feel like having a beer, go grab a single fins. That's their highest selling product, and I highly recommend it as a beer to have over Australia Day, Tim. And with that, happy to take any questions.
Thanks, Andrew. I certainly will have a beer on Australia Day. Just starting, let's go back a sec. You're a value investor. How does value investing match up with some of the sectors you've been talking about, like resources and lithium and things like that?
Yeah, so it does get a bit tougher for us in some of those sectors. So we tend to focus on producers, and there's obviously a number of producers in Australia, or it's a developing company that maybe is 12 to 18 months away, but they've got their financing in place, they've raised enough capital, or we're part of the solution to raise enough capital to de-risk that project, and we can see cash flow within 18 months. That's basically what we're looking for, Tim. If there's not current cash flow, we need to see it within 18 months. We're not going to wait 5-10 years for positive cash flow. So you can still find that in healthcare. We've had some great success. Genetic Signatures, if you saw their quarterly a few days ago, huge cash flow. In fact, the money we gave them this time last year hasn't even been spent. They've grown their cash pile. They're up over $36 million of cash. So you can, because the universe is so big, you can combine companies that are growing strongly, which is what we all want, with good value and good cash flow. And that's what we love about micro and small caps. It's just such a big universe and healthy universe in Australia.
And is this particular end of the market inefficient because there is a lack of research?
Yeah, you've hit the nail on the head, Tim. I used to be a broker many years ago, and actually the amount of people covering small caps has dropped versus then. So that was almost 15 years ago I was doing that. So there's been a real brain drain out of broking, and particularly smaller micro caps. It's hard as a broker to make money covering those businesses, unless you're the corporate broker, in which case you're probably a bit conflicted. So that's why we have such a big team, and that's why it's great for those that want to spend the time to do their own research. I do feel there's big inefficiency in the smaller micro caps, and you do your own homework, do your own research, you can find some gems before someone else has found them.
And at that IPO end, given the sort of market we're in, are you seeing really stretched valuations?
Yes. Yeah. So we were very cautious with a bunch of IPOs, and pleasingly, there's quite a few that dipped below IPO price, and we didn't participate in them. It's a challenge. We're looking at some right now, and they're sort of beyond where we're comfortable from a valuation point of view. Love the business, so that's causing, so we're gonna avoid that, and actually pivoted. In the case of Good Days, which is the old Gauge Roads, the brewing company I mentioned, we saw two companies trying to IPO that were in the same space. And then we looked at Gauge Roads, which is already listed, and said, well, hang on, we can buy this for a quarter of the value that you're trying to float at. So we just went and bought more Gauge Roads, which is now Good Days drinks, because they've got some other brands in there. So yes, if we're not seeing good value in IPOs, we'll shift our capital towards more listed names.
And you have got a kind of an unlisted or pre-IPO sort of fund. What sort of opportunities do you see there, and what's your kind of time frame in terms of holding before they become liquid and listed?
Yeah, it's been really successful for us, Tim, that strategy. I think we had eight private companies come to market in the second half of last year, and they've all traded up from IPO. And I think by getting involved with these companies 12 to 18 months earlier, we're aligning ourselves with founders. So they're growing growth capital. They're not selling equity down. They're after capital to help grow their business and fulfill their ambitions for the business. So when they come to IPO, we can help align that with good valuation. We add to our investment at IPO, so we want a good valuation. And we're seeing some great opportunities there. We do tend to stick to technology, healthcare, sort of non-cyclicals in the private space, and that's just because, unlike the chart I showed you before with the cycles in the markets, in the private space, you can get trapped. So we don't want to have any cyclical businesses. So we do tend to narrow our focus a little bit in the private space to technology, consumer brands, and healthcare.
And so how do you manage risk if you're concerned about this year potentially stretch valuations? So obviously you got mandate limits and issues around liquidity. How do you manage risk?
Yeah, so we're trying to increase our liquidity at the moment, so moving into more liquid stocks where we can. We've put some put options on the market, Tim, so we do have some protection if the market falls, but that's only, to your point with mandate limits, it's only going to be a bit of a cushioning impact. And we're probably doubling down on our valuation discipline. So as the market's pushing valuations up this way, we're actually forcing our valuations down the other way. So we're probably doubling down on that valuation discipline. And
Andrew,
potentially too early, but it's okay.
Sorry, what was that?
Potentially we're doing that too early. Like, this market could obviously keep running and valuations keep going, but our history informs us that being conservative and going the other way is probably prudent at the moment.
Yeah, we're certainly seeing stocks kind of have a 10-year movement overnight sometimes. And finally, I know it's difficult to predict what's ahead, but what worries you?
I think the market's dealing with something I haven't seen for a while, which is inflation. Now, whether that's maybe another year from now, but a lot of investors who are in the market now haven't seen an environment with inflation, and even people in my team haven't had to deal with a reasonable level of inflation. I think there's a strong chance that we start getting inflation through the system again. That can be great for some companies, but there's other business models that are weak, that don't have any pricing power. They can't pass on that inflation. Their margins get squeezed, their share prices come under pressure. So that's something that we're sort of going to focus on in reporting season, the pricing power of all the companies that we're involved with, and probably start to move away from those that don't have pricing power. So that would be a concern that's not priced in. Inflation expectations in the US are going up, but it doesn't seem to be going into mainstream press or anything yet. And I think that could even be 12 months away, but something we're starting to think about now.
Great, Andrew. That's all we got time for. Thanks for your time. Always great to get your insights, and good luck this year.
Thanks, Tim, and thanks everyone for listening. See you later.
Okay, next up we have Arden Limited, ASX code ADV, market cap around $64 million. The company engages in the exploration of mineral properties such as gold and lithium, there's two magic words, in both Australia and Canada. The company has had a one-year return of around 766%. We welcome back Rob Longley, who's the MD and CEO. Rob is a geologist with extensive experience in global resources. Rob, thanks for your time again. Nice to see you. Over to you.
Thanks, Tim, and thanks for inviting us in to come and give a bit of an update on the Arden story. Some really interesting insights into the industry there from Andrew, and a few points I picked up on his talk there was about the cyclical nature of the industry, especially in minerals, valuations, and gems. And I guess from Arden's point of view, we've got some hidden gems, and perhaps lithium is the one which is coming out of the closet a little bit at the moment. But we've got those fundamentals. Our main project is a gold project, which I'll talk through these slides pretty quickly. I don't want to go into too much detail. This is a bit of a general update, but we're really excited with the gold assets. And I think at that slide that you see on our corporate structure, we sort of emerged during the course of last year. At the start of the year, we were a market cap around 5 million, and now we're pretty well entrenched above 50. So for the general investors, that's been a very good return. And that comes back to fundamentals, doesn't it? Exactly what Andrew is talking about: good management, solid assets, and a strategy. So we're in a pretty good position, but it's just the beginning for us, and we're looking forward to going forward. So our market cap's about 57 or so, and we've got 3 million in cash in the bank, so a good position. Next slide, please. And we've got a lean and very keen and talented board. Neil's been with the company for a long time, so he has a lot of links back into Canada. Pauline is a very astute financial investor and is basically a lithium specialist as well. So that's becoming very essential at the moment. And myself there, Gio and Dan and a new team. We've also got Tara joining us shortly as a full-time CFO co-sec. So we're building our management team to get better prepared and to get a much stronger force going this year. Next slide, please. So there's a quick snapshot of all the Aussies that have moved into North America, and we're smack bang in the middle there with the Pickle Lake Gold Project in northwest Ontario, just north of Thunder Bay and Toronto. And we've got 3 lithium assets also in the same vicinity. And we can go as far west as Pogo in Alaska. And I've just noticed recently Nova Minerals also over there in gold, and right out to the east where Ian Murray and MZZ are doing very well in Newfoundland. So we're spreading all the way across North America because of the good investment, I think, that the ASX brings and our talent and our skills. I mean, I'm sure Steve's going to talk a bit about why he's in Argentina, and it really is that strong fiscal ability to invest and to get funding, and also our ability to explore and develop. So we're an explorer, and we're in good company in Canada. Next slide, please. So a very quick snapshot about where our projects are. That's a sort of a zoom in into Ontario itself, showing our gold and lithium projects all in the same area of northwest Ontario. And I've just sort of joined the 3 lithium projects together there, not to do anything to do with the lithium triangle, but they just happen to be in that configuration alongside our gold project in northwest Ontario. So we've got a large Pickle Lake Gold Project, which is now 870 square kilometres, predominantly 100% owned, and that sets us aside from some of the others in the area that have to do massive earnings and give up a lot of capital and share to others to buy their interest. And all of it, the lithium is 100% owned as well. So this somewhat helps us through those cyclical natures, gold and lithium. I think the Artidan management was very astute not to quickly offload our lithium assets when the worm turned, for want of a better term, with lithium. And now they're coming back as a value-adding asset into Artidan. Next slide, please. So I'll quickly do just the next 2 slides are really like our gold highlights and then our lithium highlights. Just a couple of quick slides on what we are. So Artidan's gold project is our fundamental value adder. And that's what's really shown in our market cap and our share price increase. And we're going to get a lot of news flow out of this size property. It's a district scale. So that's 100 kilometres from east to west across there. So a massive holding that we're just sort of scratching the surface of. We're drilling at Casageminus, which is our central gold deposit smack bang in the middle there. And that's got an existing JORC resource. That's our sort of starting point. And we did summer drilling there well into December last year. We completed 3,000 metres of drilling, and we're just about to recommence winter drilling in that area. We also, in the neighbourhood of Evolution, who obviously took over the Red Lake operations to our west, and we've got a couple of juniors in the area working hard, adding resources in the vicinity. There's 3 or 4 historical significant underground gold mines in this region that produced over 3 million ounces at well above 10 grams per tonne. So it's a good neighbourhood. We've got a good acreage, and we're working our way through it. Next slide, please. Which is I'll just quickly touch on lithium and then come back to gold basically. But for those that were curious about what Artidan have done with their lithium assets, we're still holding them. It was our strategy from the assets to hold on to them, look to add value, and that may now be coming back into clear focus. I've tried to color code our lithium projects in terms similar to our gold. So the purple is our strongest asset. Orange is sort of like our second cab off the rank. And green is our sort of greenfields lithium where we haven't done any work. So Seymour Lake, before my tenure at Artidan, was very well drilled. There's a very high grade, very good metallurgy around the Seymour Lake lithium project. And they've established a 5 million tonne resource there at 1.25%. There's an exploration target there that could add another 4, 5, 6, 7 million tonnes. And I think there's extra potential if you broaden your search in that land holding at Seymour Lake. All of these tenements are 100% owned. There's no earn-in, and they're all in credit. So we're not under any immediate pressure to go and spend money on them. We're still focused on the Pickle Lake Gold Project, which you can see there in the middle is the orange or golden tenement spread. What we have done over the last few months is have a quick look at Root Lake, which is just 50 or 60 kilometres southwest of Pickle Lake, so very easy to get to. And we've done some sampling in there and just reaffirmed what we like about the Root Lake lithium prospect. Artidan did some test drilling there when they first put it in about 2016, and they were clever enough to drill down dip through one of the pegmatites just to prove the continuity of these pegmatites. You know, are they substantial, as you'll see in the next slide, and what sort of grade? So they drilled down dip, so this isn't a width, but they drilled through a lithium pegmatite and got 67 metres at 1.7% on average. So very good quality looking at Root Lake, and we'll be evaluating what we do at Root Lake as the lithium industry and market appetite moves forward. Now down at Weiser Lake, which is right on the US border, very close to where our incoming CFO and co-sec Tara comes from, on the other side of the border, although she's been lived in Australia for many years. There's a fantastic looking swarm of pegmatites down there that have a good grade that we haven't even stepped foot on the ground yet. So we've got some work to do with First Nations and the community around there to explain to them what we're doing and make sure, as we're doing at the Pickle Lake Gold Project, going about this exploration and development in a very sustainable manner. So that's our lithium projects in a nutshell. Very good at various levels of evaluation, low iron. So we know we've done a 2.5 tonne sample at Seymour Lake, and we've had very well qualified metallurgists look at it and are very happy with the flow sheets that come out of the potential way to process that. Next slide, please, which is just a few snapshots from Root Lake. So I've done a little bit of lithium exploration here in Kalgoorlie in the goldfields, and literally you're on your hands and knees with a magnifying glass trying to find flakes of anything, mica or spodumene or petalite. What we've got at Root Lake is a busting pegmatite jumping out of the snow, as we were there a little while ago. You can see that the photograph on the left there, there's a green circle. There's a guy in the middle of that to give you some sense of scale of that outcropping pegmatite. And over on the bottom right is a close-up picture of him standing on that pegmatite, which is loud and proud with spodumene crystals all the way through it. So that's a very exciting outcrop to be able to attack. And as I mentioned before, that's the Macomb deposit, which is up in the top left of the geophysical image. And we've got a long strike length there of the Macomb, the Morrison and Root Bay that's not really explored at all. But there's 10 kilometres of pegmatites running through that property, which we own, which we can bring into action as the market sees fit. So that's kind of it for lithium, and I'll jump back to gold if we can go to the next slide, but I'll take questions on lithium if that's got its moment at the moment in the market and people are curious about it. Our key project has been the gold project, and it's the Pickle Lake Gold Project, where we've put together a project of consequence and of size that has every opportunity to make major discoveries. Now we've started at Casa Gimnus because we had access there, but it's by no means what we think is potentially our biggest discovery to make. But we're drilling there, and we'll be drilling there again shortly. So the majority of these prospects we all own as well. So there's no massive giveaway of equity or cash to keep growing. So we've got 3 principal deposits to attack: Casa Gimnus, Dorothy, Dobie, and we've got brownfields directly along strike of the existing head frames, and a whole bunch of greenfield gold prospects that we haven't even really got to yet. Next slide, please. So I'll just touch on Cass. So that's the yellow box there. This is an aerial view of Casa Gimnus, the main deposit area, is where we did our summer drilling, and in every hole we drilled there, we hit gold and sulfide. So we're very excited by that. We still haven't got the final assays from there. The labs in Canada are absolutely snowed under in both senses of the word. But we'll get those results out from the last couple of holes at Cass as soon as possible. What we're planning at the moment is the purple box there to the east, which is drilling where nobody's really drilled before, on top of a frozen lake. And there's a couple of pictures in the next slide to help describe what that means. And perhaps we'll just jump to that next slide so that I can get through and give other people plenty of time. That's what it looks like on Cass Lake as of the last couple of days. We're clearing snow off of the lake to allow the ice to thicken. We'll be adding water to that to thicken up the ice. So we're making good preparation to be drilling on Casa Gimnus in February. What we're going to be doing in the very shorter term is drilling at Southland, which doesn't need ice. So the temperatures there, I don't know if you can read that, it's minus 20 degrees at the moment Celsius in Pickle Lake. So good season, and the guys are making really good prep progress there. Next slide, please. So what we are doing, we're hoping to start drilling this weekend, potentially. Our drill foreman is on site at the moment looking at these drill pads, is drill at Southland, which is the orange banana you can see up in the top right-hand corner of that map on the left. And down in the bottom left, the purple banana is Casagimina. So very close. And we're building winter trails, as you can see there, with dozers through the ground to get better access to that, so we don't have to rely on helicopter support. So make it far more efficient. And some really good targets at South Limb, directly on strike of the Donna Lake gold mine to go and explore. So that's South Limb. Next slide. I won't talk too much about this, but this is what really excites our investors and our GOs and our geophysicists, ESCA. And the anomaly there directly along strike of that prospect is a gangbuster. We're really excited by that. So we hope to get up there in the next half of this year. Next slide. I see Tim coming on, so I'm probably going to get the wind up. A couple more slides to go. That's our news flow coming up. We've still got to get our December quarterly out. We hope to do that next week, and I hope to include the last of those CAS results. But we're drilling at South Limb next week, drilling at CAS straight after that, First Nation agreements, updating our JORC resource, and then looking to get out to our third gold prospect later in the year. Next slide, just a quick wrap up of what we've done over the last 12 months. As that gold price has increased, we've increased our gold project from what it is on the left there, a very small land holding, into a massive, principally 100% owned district scale property that we've got, as some people like to say, lots of chocolates in the box to work with. And an increase, as Tim kindly pointed out, for our shareholders over the last 12 months, which is significant. Thanks, Tim. I'll hand back to you and take any Q&A that comes up.
Thanks, Rob. No surprise, there's lots of questions on lithium. So one of the questions here is, are there any advancements between Arden and Roxtec Lithium that you can provide to the market? I understand it's a sensitive subject, but there's a few questions around that. Yeah,
no, sure. Look, Roxtec, Dirk, we've been talking with Dirk for a couple of years now. Harbeki, he's a really clever guy and really good guy to work with. We've looked at each other's ore bodies. We're still talking together. They understand ore body. We understand theirs. We're very close together. Roxtec only have lithium, so they're doing the hard yards on lithium while we concentrate on gold. They're now talking with Avalon, which is another group further west in Ontario. So they're spreading their wings in that region and talking about a processing centre potentially in Thunder Bay. So they're doing a lot of hard work there, and they've been reflected in their market cap increase as well. So they're doing really, really well. For the time being, we're not doing anything actively with Roxtec, but I think the narrative is that all of the lithium players in this area, including Quebec next door, are looking for alliances, offtake agreements, ways to grow. Nobody, from my knowledge, is putting drill rigs on the ground. So lithium is a very different beast to gold. The people that invested in Arden invested in gold in the last cap raise, and that's what we're focused on. But we'd be silly not to keep an eye on lithium and look to where we can value add and potentially bring that value either into gold or let lithium have its run as a separate entity. All those cards are now back on the table. I guess from Arden's point of view, the shareholders, if lithium and gold are both strong this year, we'll be in a very good place.
And the lithium is actually spodumene based. Is that a concern in terms of its carbon footprint and what the producers are after in terms of the EV battery makers?
Well, that's a complex question, Tim, that I don't want to take up everyone's time talking about. But spodumene, and obviously Steve's going to talk about brines and how they work. I'm trying to keep the narrative around our lithium pretty simple in terms of exploration. It is all spodumene. It's well-known process. There's new technologies coming in that may be more efficient ways to produce products, intermediate products and final products. Roxtec are talking about doing an intermediate product in Thunder Bay off to Europe. There's a new critical materials and minerals body in North America to try and bring more of that into the US market. So it's a very active market. And as Andrew was saying, I think you've got to be careful with the volatility in markets. Lithium isn't as easy to predict as gold is. So gold is strong. Lithium will add value. And as a geologist, I'll stick to geological advice, and as a board, we'll stick to the strategic advice of Arden and let the lithium experts really explain what they're doing. And I'm sure Steve will do that in the Argentinian brine sector.
Thanks, Rob. And just only got time for a quick last question. You've got 2 billion shares on issue. Is there any plan to kind of have a consolidation in 2021?
There's nothing definitive. It comes up in the narrative all the time. Some people like the liquidity in that. Canadians don't understand it, but we're not planning on any TSX listing. There's been no hard and fast complaints come into us, but obviously that's something you need to look at. I talked to Mark Wilson at Legend quite often around Perth. He's got a similar number of shares on issue and a much bigger market cap. There's different opinions on it, but it has to usually be with some sort of major transaction or a spin out or some movement whereby people don't get nervous that you're doing it for the sake of it. It has to be done for a reason and the right support, I think. So it's always in the narrative is the short answer, and we're looking at that. But others, like that liquidity in the market.
Fair enough, Rob. Well, thanks for your time. Good luck in 2021. It'd be great to get you back at some point later in the year.
Thanks, Tim. Hopefully from Canada. Hopefully we can all start moving around.
Yes, thanks, Rob. See ya. Next up, we have Therapeutics. We welcome them back. ASX code KZA, market cap around 150 million, 1 year return of around 100%. The company is an innovative oncology-focused biotech company. The company's pipeline includes 2 clinical stage drug development candidates, and they are working to develop therapies across a range of oncology indications. The company now has an ADR listing and is attracting big volume, and there's some big interest in the US. We also have research available on Therapeutics on the ShareCafe website. We welcome once again James Garner, Dr. James Garner, who is the CEO and Executive Director. Thanks, James. Over to you.
Thanks, Tim. It's a pleasure to be back. Ladies and gentlemen, good afternoon. It was about third quarter of 2020 when I last presented to ShareCafe. So I really wanted to use the next 10 minutes or so as a little bit of an opportunity to update on CASIA. As you've heard, it's been a really big year for our company and a big fourth quarter. So I wanted to just recap some of the important things that have been happening in the last 3 or 4 months. Just first of all, a brief reminder of CASIA and a brief introduction for those who are unfamiliar with the story. We are an oncology biotech company. That means we do nothing but the development of drugs for cancer. And cancer is about half of the global market for new medicines these days. So this is very much the most important part of the commercial opportunity. We're a late stage company. That means our drugs are in human trials, and specifically our lead drug is in a pivotal study, which is the final stage of trials before commercialization. So we're very late in the game as a company. Our lead drug is called paxalosib, and it's being developed for brain cancer, and particularly for a form of brain cancer known as glioblastoma, which is the most common and aggressive form. We also have a drug called Cantrixil, which is being developed for ovarian cancer. I'm not going to talk about that today because it's a little bit earlier stage. So next slide, please. This slide is just a real high-level summary of some of the key points around paxalosib, and I won't go through it in detail, but I think the first thing to say is that this is a very, very good quality drug. It was originally developed by a company called Genentech. They are the most successful developer of cancer drugs in history. They decided they weren't going to be strategically focused on brain cancer, and so they partnered this drug out, and we were able to bring it into our company. We have a very, very clear path ahead to develop this drug. It is currently in a pivotal study. That is the last stage of the research and development of a new medicine. And that lines this up to potentially be launched into about a $1.5 billion a year commercial market. And as a company, we run very lean. We're an extremely efficient business, but we have a very, very highly credentialed board, management team, scientific advisory board to drive this forward. Next slide, please. So there's 5 key things I want to talk about from the last 3-4 months, and they're listed here. First of all, back in September of 2020, we announced a new clinical study, and this is part of a program of expansion around paxalosib, which I'll talk about in more detail in a moment. This study was in a form of brain cancer called primary CNS lymphoma. And this is really interesting because lymphoma outside of the brain is a disease where drugs like ours have shown huge potential. So we're really excited now as we're looking at the brain cancer version of this disease, if you like. And this, as I say, expands the opportunity for our drug. It gives us more shots on goal, and it gives us access to a broader commercial opportunity if we're successful. In October, we raised money. We did this all on the ASX. As you've heard, we do have securities on NASDAQ, but we did our financing all on the ASX. We raised $25 million, the bulk of that from sector specialist institutional investors. And that's really important because that sets us up so that we have a very good funding base in the bank as we move into our pivotal study. And so really almost a transformational financing round for our company. In November, we saw positive data from an ongoing study of our lead program, paxelisib, in glioblastoma. I'll talk more about that in a moment. And then in December, we started a new study in childhood brain cancer in a disease called DIPG. This isn't a super common cancer, thankfully, because it really is one of the most horrific diseases in the brain cancer field. But it's an area where we've been really excited to see some encouraging data. And so we're thrilled to be moving forward. It's the very definition of a high unmet medical need. And then in January, we opened the first site to paxelisib in our pivotal study, GBM Agile. And that really makes us, quote unquote, a phase 3 company, very much at the final chapter of the drug development process. Next slide, please. Now, this is a summary of the data we've been seeing with paxelisib. We're comparing our drug paxelisib here, the blue bars, against the existing FDA-approved standard of care, which is a drug called temozolomide. That's in the gray bars. And you can see here 2 measures of the effect of the drug. One, progression-free survival, measures the ability of the drug to delay recurrence of a tumor. The right-hand side shows overall survival, which is a measure of the ability of the drug to extend life. And focusing on the right-hand side of the slide, because that's really where the action is, we see with paxelisib an overall survival of 17.5 months. For temozolomide, the existing FDA-approved standard of care, that figure is 12.7 months. Now, this isn't a perfect comparison because we're comparing data from our study versus data from a pre-existing study of temozolomide. But the magnitude of difference here really gives us a lot of confidence that, to put it simply, paxelisib works. And on that basis, we've moved into a pivotal study for registration. Next slide, please. Now, I did mention that glioblastoma is not our only shot on goal. It's our primary focus because we think it's the quickest and least risky and smoothest path to market. But we do also have a very, very broad clinical trial program, as you see here, with activity in DIPG and primary CNS lymphoma. These are 2 other forms of brain cancer. Also 3 studies in brain metastases, that is cancer that has spread to the brain from elsewhere in the body, breast cancer, lung cancer, melanoma, for example. So this is an incredibly broad program, really, particularly for a company of our size. Each one of these represents a largely independent opportunity to commercialize paxelisib. And if several of them pay out together, it really starts to build a very, very substantial commercial opportunity for our drug. Next slide, please. This is a quick snapshot of the GBM Agile pivotal study. This is a study that's already up and running at 35 sites in the US and Canada, shortly to open in Europe and later this year in China. And we opened the first site here, in fact, Henry Ford Cancer Institute in Detroit, Michigan, in fact, just before New Year, and they recruited their first patient with the paxelisib arm active at the very beginning of January. This really is a watershed moment for our company. As I say, it marks our transition into the late part of clinical development. And should this study be successful, our expectation is that this will be used as a basis for an FDA approval. That's the point where we can start making revenue out of paxelisib. Next slide, please. And some of these milestones have really been reflected in the valuation of the company. A shareholder at the 1st of July last year would have more than doubled their money by the beginning of January. And in fact, we're up already about 10-12% so far in 2021. And I think what this illustrates is that as this data starts to roll out, as we tick off milestones in the very rapid progression of this drug, that value is recognized by the market and recognized both here in Australia and also in the US via our NASDAQ listing. Next slide, please. So finally, just a word on the year ahead. We've really got 4 things we're aiming to do this year. Faultless execution of the GBM Agile study clearly is an absolute priority for us and something we'll be updating people on regularly. really trying to drive more data out of this very broad clinical trial program will just build the value proposition of Paxalosib. Starting to talk to companies about partnering opportunities is a key goal for this year. Most companies like ours don't end up selling the drug themselves. They partner out to a larger company. That can happen at any time in the development cycle, and it's certainly an opportunity that becomes very live for us this year. And then finally, starting the process of building up towards an FDA registration. Next slide, please. And this is the last slide, just a snapshot of some of our key milestones. I'd say a health warning that I always put on our milestones: clinical research is unpredictable, especially in the time of a pandemic. So all of these can move around a little bit in the detail, and we have gone this year to reporting our milestones on a half-yearly basis until they become quite concrete, which you see reflected here. But regardless of exactly when data comes out, or exactly when milestones are achieved, each of these represents an opportunity to build the value of Paxalosib and thereby to build the value of Casia. And this represents really a very, very positive year ahead for our company. So, ladies and gentlemen, thank you very much. And I'd be very happy to take some questions.
Thanks, James. We both mentioned the ADR listing, and the ADR listing seems to be driving the share price here. It's obviously attracting a lot of interest and big volume. Is there any insight into who's actually being active in terms of buying those ADRs?
Tim, as far as we can see, it's very broad-based. I think we've definitely got on the radar of a lot of retail investors in the US. There's a lot of investors in that end of the market who are very active in the biotech sector. It's a much bigger sector in the US. There's perhaps quite a lot more activity there. But we are also seeing some institutional investors move in and out of the stock in the US. So I think that's been really encouraging too. So there's really not one single point that's driving this. I think it's really right across the spectrum, from some large funds down to some small day traders, and I think it's welcome. I think it just reflects the fact that we've arrived to a certain extent as a company, and as you say, it's been driving quite a lot of momentum in the share price.
And you showed a slide there where we're talking about glioblastoma, a particular type of brain cancer, and the application of your drug, and then you showed other potential diseases. Does FDA approval cover that range of diseases?
We need to show data for each disease that we're looking to approve the drug in. So we don't get them all in one go, but having got the drug approved in one disease, the subsequent approvals become much easier. So what we often see with cancer drugs is they'll get approval initially for a particular patient group, and sometimes that's quite restrictive. It can sometimes be quite a focused group of patients. But then over the lifetime of the product, that builds out with subsequent approvals that extend the life of the drug. And that can be as frequently as almost every 6 months or so. And we see the likely trajectory for Paxalosib looking very similar. I think the most likely outcome here is an approval in glioblastoma, but then that would rapidly be followed by other approvals in other forms of brain cancer, and indeed potentially in other forms of cancer outside the brain. So there'd be a lot to keep us busy even after the drug is approved. It's certainly not an all or nothing event. It's a constant process of refinement and improvement, even once the drug becomes a commercial product.
And there is obviously there's always a question around FDA approval. What's the time frame for that?
So best case for us looks to be about 2023 at this stage, and perhaps a more conservative case would take us out to the following year. Having said that, there is plenty of room for surprise, and that can come from a couple of places. So first of all, the GBM Agile study, our pivotal study, is an adaptive study. It can produce data at any time and potentially give us almost a fast track opportunity to FDA. We also have some of this work going on in other diseases that, were it to show a positive result, could move one of these other forms of brain cancer into pole position. We could, for example, end up going to FDA first of all with childhood brain cancer, and that could happen sooner than glioblastoma. So there's a few ways in which this could happen much sooner, but as a sort of cautiously optimistic case, I think we'd say 2023. I'd also say that's not the only way that we generate revenue from this asset. So it doesn't mean that we can't make any value out of Pax Salicid until then. What companies like ours often do is they partner these drugs to larger companies, as I touched on. That's a transaction that could happen anytime. That could happen next week, next month, next year, and so on. And so we have a growing opportunity to monetize Pax Salicid even before we achieve an FDA approval.
Great, James. Thank you for your time again. That's all we have time for, and we'll welcome you back later in the year.
Thanks, Tim. Thanks very much.
Thank you. And finally, we have Lake Resources, ASX code LKE, market cap of 160 million, a one-year return of 325%. The company is a clean lithium developer utilising clean, direct extraction technologies for the development of sustainable, high-purity lithium from its flagship Kachi project, as well as 3 other lithium brine projects in the Golden Triangle in Argentina. We welcome back the Managing Director, Steve Prominence. Steve, it's a red hot sector at the moment. Thanks for your time. Over to you.
Thank you, and thank you very much for the opportunity to be back here. Yes, as you've just put there, obviously there is a disclaimer. If we could just move on to the 3rd slide. So what the Lake is focused on is the battery material supply side, particularly lithium, but there's no mining involved in what we do. This is just water treatment using clean technology to produce high quality products with very low impurities, and doing that in a more sustainable and responsibly sourced way. We're a lithium developer. We're in the middle of a definitive feasibility study at the moment. We'll be moving into construction finance this time next year at the end of that detailed feasibility study, and having a demonstration plant running on site. So it's a pretty exciting time, and you can expect to see a lot of news this calendar year and next calendar year. If we have the next slide, please. So the interest and the reason that we focused on this space is basically summarized in this slide. On the right-hand side, you'll see the growth in mega factories. Now, these mega factories are factories that produce large amounts of lithium-ion batteries. Last year, there were 70 scheduled. In December, there was 181. That is a massive amount of growth. And of those 181, 118 are actually operating. So that beast has got to be fed. And the materials that got to go into it, lithium, nickel, manganese, things like that, that is important. But we've seen this story, and actually I presented here on ShareCafe for the very first time late last year, just after we'd produced some very high quality results. Yet it's only been until the last few weeks that we've seen the lithium price start to move. November, December, we saw the complex go up about 11.5%, spot pricing for carbonate go up about 20%. And now in the last 2 weeks, we've seen spot pricing for lithium carbonate go up another 15 to 20%. So that's why there's a lot of interest in the sector right now. Next slide, please. What we're focused on is using a better way of producing a very high quality product. And so we've gone back to water treatment. That's all it is. In the lithium triangle of Chile and Argentina, you've just got dry salt lakes. Think of Death Valley in California, or some of the salt lakes you might think of in outback Australia. But underneath the surface, that salty water also has a certain amount of lithium that's dissolved in it. What they do at the moment is they bring it up to the surface and evaporate that water and take the salts out of it. What we do is a very common water treatment process called ion exchange. That's just been adjusted slightly so that you take the lithium out of the water. The beauty of it is you get all the lithium out, 80 to 95%. It happens in the space of 2.5 hours, not months or years. You produce a very high purity product because you're just taking the lithium out, and we're doing that in a cost competitive, scalable, and environmentally friendly way. Next slide, please. So graphically, this is basically what it looks like. To summarize this slide, on the left-hand side where you see that tank or module, there's about 50 of those in full production. They replace the evaporation ponds. Everything else is exactly the same. But as I mentioned, because you just take the lithium out, you produce a very high purity product that gets converted into carbonate. And because we're using ion exchange, where you just bond these little ion exchange beads with the lithium, there's no chemicals involved. So we can just release the rest of the water, which is 99% of it, the salty brine. It can go back to where it comes from. And this is a great outcome environmentally and for local communities. Next slide, please. What we've done at the moment is we've tested this process in a pilot plant module in California. We would have had one on site last year if not for the pandemic. And we're going to keep operating that pilot plant module all of this calendar year and sending more brines from our site down there. But the beauty of this process is now that we've demonstrated it works on pilot scale, it is only a relatively small scale up to full production. Now, normally for most commodities at this stage, you're looking at maybe 50, 100 times scale up. But here we're talking single digits. Why? Because what happens with water in one tank is going to happen with water in 20 or 50 tanks. And that's really the beauty of the work we've done to date and was our focus last year. And we're pretty happy now to be heading straight first into a definitive feasibility study. Next slide, please. So just to give you an idea of where lithium comes from at the moment, in the top left-hand corner here, you see what looks like evaporation ponds in the north of Chile, in the north of Argentina, in the lithium triangle. So just imagine you're sitting there, you're looking out across the horizon, there's 10, 15, 20 square kilometers of evaporation ponds. That works very well because you're using the power of the sun. You concentrate the salt because the water gets evaporated, but then you have to separate out the lithium, and more the battery industry is looking for high quality. On the other side, you have a hard rock mine. These can be smaller or bigger. They look a little bit like a gold mine. But what we do is just imagine that same salt lake, but you've got a physical footprint of 1 or 2 city blocks. You return virtually all that water back to where it comes from. This is a great outcome. That's why we're focused on it. Next slide, please. We've been able to show in our pre-feasibility study that the operating cost is about the same as other brine producers. Lithium brine producers are generally somewhere between $3,750, $3,800 a ton, up to $4,200 a ton. Our modeling in the pre-feasibility study puts us at $4,170 a ton. That was using a very high cost of energy. And we're talking to solar hybrid producers now to perhaps lower that operating cost a few $100s a ton. But the beauty is because we're producing a premium product, very high quality, we can sell that at a premium price. And that's really where it becomes quite exciting. Next slide, please. So where are we? All of the lithium brine producers are in the north of Chile and north of Argentina. All of the big 5 companies, Albemarle, SQM, Livent, Tianqi, and Ganfeng, all either run operations or have significant equity interest in operations. You see that orange circle at the south, that's the one I'm going to be talking about, Kachi. It's our flagship project because we own the entire basin. But we also have projects alongside Orocobre and another company called Lithium Americas with their joint venture partner Ganfeng. As a matter of fact, we're the only junior in that area of Cauchari and Olaroz. Lithium Americas has a market value of $4 billion for half of that project, Orocobre north of $1 billion. So we're well located amongst the majors. We also have a very large property position, 220,000 hectares over 4 projects. So that's a pretty significant leaseholding in a 100% basis. Next slide, please. So in Kachi itself, it looks like any other salt lake. We've got a significant resource, 4.4 million tons. What that means is using this direct extraction process of 25,000 tons per annum, that's about 8% of the market, we can produce that for 25 years and not even use 20% of the resource, and yet we can expand this resource laterally or at depth. To give you an idea of that, that leaseholding package, particularly for our American investors, that's the size of the entire New York City or 12 Manhattans. Next slide, please. And so the benefits are it's large and expandable. The method we're using is also modular and expandable. It's cost competitive. It's a very high value, long life project at the moment based on our current modeling, and that's looking to get a whole lot better. Next slide, please. So this year we've commenced our definitive feasibility study. That's a mock-up of what the plant would look like. Really, the only thing that's different to other brine evaporators is that letter A on the right-hand side. That's a shed or warehouse with 50 or 60 modules in it for direct extraction. The rest of it is pretty standard, but as you can see, then you don't need the evaporation ponds going across the horizon. Thank you. Next slide. So it's one thing to produce a high quality product. We were very fortunate back in October to be able to announce that we've produced the highest purity product that anybody we could find was able to produce at scale. And that gets us the entree into some of the household names in the cathode battery and electric vehicle space. But to ensure that occurs, we're working with the well-known company called Novonix here on the ASX. They've been running battery testing now for more than the last 10 years out of Dalhousie University in Nova Scotia, Canada. They work with every big name you could think of. And it was great that they're now taking our high purity product, putting it together with other cathode materials and making batteries, cells and packs out of that. And then that makes our discussions with off-takers much better, because we don't want just any off-taker. If we can actually get a tier 1 off-taker, we know that that essentially guarantees our future and the capacity to scale up. Furthermore, Novonix just this week announced the return of Dr. Jeff Dahn. He's one of the legends and icons of the battery technology space. He's actually returning to the board of Novonix, maintaining his activities in Tesla. And Tesla have extended their financing to Novonix out until 2026 to access that technology. And as all of you know, it's helped by the company you keep. This puts us right along line with the sorts of companies that we need to be talking to. Next slide, please. So quickly on our production timeline, definitive feasibility study this year, environmental and social impact study. We'll be running a demonstration plant on site. We'll keep that pilot plant running in California, but we aim to have one on site probably in the second half. The results will be coming out of Novonix, demonstrating how well this works in batteries over the coming months, and we aim to have a feedback loop and how we can perhaps even improve upon that. We'll continue to send samples off to potential offtake partners, and then by about this time next year, or half one next year, we aim then to be finalising financing and getting into construction. The next slide, please. And so quickly on the company, you heard Tim mention, we've had a reasonable run in our share price. That's been helped a lot by the fact we have an OTC listing in the United States, and we've had a lot of buying out of there recently. That's helped our share price. We are playing a lot of catch up. I will be very blunt. You heard the previous producer talking about biotech and health. We're basically in the clean tech and new energy space. Those areas have got a lot of interest in the US. Now the funds under management have picked up from about 15 to 33% looking at ESG investing, and we're pitching right into that. And just go through the last slide to the very last one. Next one, please. And so in summary, clean technology, high purity, responsibly sourced. This is a 21st century solution to batteries for electric vehicles. Thanks, Tim.
Thanks, Steve. Always good to hear an update. So in terms of the lithium market and lithium pricing, what sort of encouraging signs you're seeing in the lithium markets at the moment?
So when I was last on here, I'm sorry, I can't quite remember what it was, but it was latter part of last year. We've been talking about what was just so obvious at a macro scale, that electric vehicle makers kept announcing new models. Battery makers kept announcing new plants that we're building. And the amount was coming out, just Tesla alone on Tesla Battery Day back in September, they came out with a number that immediately doubled the amount of batteries that are going to be produced in the next 10 years. And so at some stage, that's got to feed to the upstream, lithium, nickel, etc. And I was wondering what it's going to take. We saw finally, after about 2.5 years in the toilet, we saw lithium prices pick up in November, December. And now the start of this calendar year, the spot pricing, particularly out of China, has gone up significantly, and that has awakened interest in the whole sector. Secondly, we saw the EU announce in December 10 that from the middle of 2024, all of batteries have to have an ESG CO2 footprint going in there. We fit perfectly into that space. And then last of all, with the Biden administration coming into the US, most people are expecting more funding to go towards renewable energy and towards electric vehicles and charging stations. So I think that's helped the overall sector. But look, at the end of the day, we're in that more clean tech space with an ESG benefit. So I think we get actually an extra tailwind as well.
Yeah, I mean, there's a question here, you know, we are starting to hear more and more about that direct extraction through that ion exchange in both the lithium and the nickel markets. Can you talk about your competitive advantage in this kind of clean tech area?
So on the TSX in Canada, there's a company called Standard Lithium, and they have a project in the United States. They're also using direct extraction. They've been running a pilot plant, which they call a demonstration plant, and they came out with their results in December. Their method is slightly different to ours, but they came out with the results in December with very high purity lithium carbonate, 99.92%. In October, when we came out with our results at 99.97, people, I think, suspected that maybe that's not right. Maybe that can't be true. Now there's another peer who's doing the same. Their market value since middle of last year has gone from 50 million to 550 million. And so I think that the penny's starting to drop, that this is a space to get into. Specifically with Lake, we like the Lilac technology. We have, as mentioned last time, exclusivity over key areas in Argentina. We're working with them to long-term to develop this project. But specifically in the lithium triangle, what we see as the benefits is 1, you return all the water back to its source. 2, its actual use of water is quite low. 3, it occurs at ambient temperature, so there's no heating or cooling. And then 4, like the other direct extraction methods, it produces a very high purity product. Look, with the interest in the sector at the moment, I suspect anybody at our stage and development stage will probably get funding, but there certainly are some questions going forward as to whether other brine producers will continue to attract that funding.
And the agreement with Lilac, who is your technology partner, how long is that for, and does that preclude anyone else in Argentina from using their technology?
So it's a long-term partnership, and it's for the life of this project at the very least. They provide beads and their technology to ensure that we end up with a great outcome. There are exclusivities over key areas. We've left them to be able to develop this technology in the US, and we hope that they do so. But the big brine projects are here in Chile and Argentina, and it's just easier to get projects permitted in Argentina. There is a benefit in coming to market first with this, and there's also a benefit that this project can be scaled up. And over the next little while, there will be more information that we'll be able to share publicly about a much closer and more transparent union between those two entities.
And there's a question here on, what's your kind of timeline to production? What are the major catalysts that we should be looking towards?
Okay, so just on the timeline, as mentioned on that one slide, this year the focus will be on the definitive feasibility study, environmental social impact assessment, getting those finished. Separately, getting the results back from Novonix, seeing if there's anything that we can do to even improve upon that. We're looking at ways where we can improve that quality perhaps to 99.99% because high purity is very important to the off-takers. Together with that results out of batteries, then we continue to talk to cathode makers and battery makers, some with new technology, some that are much larger. So it's quite likely we'll be able to say something about some of those household names that I've been talking to right across up to electric vehicles. I can tell you that because we've got this ESG benefit, there'll be some news to share on that. And I must say the interest that's coming out of the US, they really get this whole space, and I think that will help us significantly as they expand their battery production, cathode production, and we see more and more EVs in the US.
And Steve, just one last question. Your high purity samples are obviously with Novonix. Have you sent those to any other potential off-takers?
Yes, we've sent them to off-takers. Novonix isn't an off-taker per se. They're demonstrating that this works in batteries so that we can demonstrate to everybody else. The problem is when you deal with off-takers, it's a fairly opaque process and also can take quite a while. We're small, we're not in production. They're very large. So by demonstrating that it also works in batteries, that makes the EV makers more comfortable. And so we've been saying to them, if you want this in your supply chain, put us in contact with your cathode and battery makers. So we're doing a bottom up as well as a top down approach. And that's certainly been resonating more recently.
Steve, thanks for your time. The share price has had a great start to the year. You've attracted a lot of attention offshore in your OTC listing. I know there's plenty of news to move forward and to come to market. Good luck with the rest of 2021, and thanks again for your time.
Oh, thanks, Tim. And look, just as a final comment around those things around valuation, look, back in May, this thing was valued at 29.30 cents. We're playing catch up now that lithium prices have picked up. You put those into the model, it makes it look a whole lot better. So I think there's still plenty of upside here. Thanks so much. Cheers for now. Makes sense to me, Steve. Thanks for your time. Everyone, that's all we have time for this week. We've got a full lineup organised for next week. Great to be back and see you again. Ciao.